So let's get started. Without further ado, let me introduce you to our star-studded lineup, or star-studded from an L&C perspective for sure. First, we have my fantastic co-host, Siobhan Barrett, who is Head of Partnerships Marketing at L&C and has recently joined the business within the last 4 months, so still relatively new. Siobhan comes from a financial services background, working amongst mortgage brokers for the last 7 years, with her most recent position being at the Mortgage Advice Bureau as online mortgage advisor. And working for NatWest Bank as well. We've got David Hollingworth, who's been working at L&C for over 25 years. His opinion on the market is regularly sought by the national and trade press. And we also have Rahul Nath, who's been working at L&C for over 15 years, with a range of roles spanning across the advice function, with a particular expertise in large loans. Myself, my name's Joe. I've been with L&C for a few months now, heading up the customer experience team. I've got plenty of financial services experience, having previously spent 8 years working for Nationwide Building Society, but I absolutely would not come to myself for financial advice, so we'll leave that one to the experts. Hopefully that gives you a little bit more of a view as to who we are. And I think, Siobhan, I guess we're probably ready to start, right?
Brilliant. Thanks, Joe. So now that we've got the introductions out of the way, let's get started. So before we do a deep dive into all things remortgage, I'm going to hand over to Dave, who's going to give you a little bit of an overview of who L&C are, if you don't already know, with some key stats around our performance in 2024. So over to you, Dave.
Thanks, Siobhan. Good evening, everyone. Yeah, we won't dwell too much on these stats, but you can pick up a few on there. Gives you an idea of what L&C is about and perhaps our size. But essentially, we are a mortgage broker who's looking to make your life easier when it comes to getting a new mortgage, whether that is for remortgage or whether you're buying your first home or a next time buy. But you'll see there some of these stats are from last year. Did nearly 74,000 mortgages, so we're certainly used to dealing with lots of mortgages. That amounted to nearly £12 billion worth of business. But really, we're more proud of those on the right hand side. You'll see there 93% of our customers recommended us. And I like to think that's because what we're trying to do is tailor the advice to pinpoint the right lender and the right deal for each individual circumstance. There's thousands of deals out there, so it's ever more complicated trying to find those. And thankfully, that has been recognised. We've actually won over 170 awards now. And all of that business we do without charging any broker fee. So the advice is free to you. So hopefully that gives you an idea of what we're looking to do. We're dealing with over 100 lenders across the market now. So it really is looking to pinpoint the right deal from across the market for you.
Thank you very much for that, Dave. So now hopefully you understand a little bit more about L&C. I think we're about ready to start talking about all things remortgage. So why does this webinar matter? So with rising rates, the cost of living crisis and missed opportunities, this seems like a really, really good time to understand the market. So Dave's now going to give us a bit of an overview as to the current market, which should hopefully help provide a little bit more insight about when you're looking to remortgage. Back to you, Dave.
Thanks, Joe. Move on to the next slide now. I'm going to spend a little bit of time looking back, just so you get a better feel for what's happened in recent years. It's been a particularly volatile period in the mortgage market, and I think that's often leads to people asking the questions around what's the right step next. The first slide, just because it's everyone's favourite, house prices. We're all a bit obsessed with house prices, I think, in this country. But it's also important to have a rough idea of what your property value is going to be, because that will have a bearing on the kind of remortgage deal that's going to be available to you. So these figures are from Nationwide's house price index. There's plenty of different indices out there. But what you do get a general picture of, particularly on that left-hand graph, the annual percentage change in UK house prices. You can see just how that was spiking in the post-COVID era, when demand for housing was just so high, the market went crazy. That pushed the rate of inflation up hugely. But as rates have risen in the last few years, you can see how that's dipped back. So the knock-on consumer confidence has impacted that rate of house price growth. But if we turn to the one on the right, the red line, the average UK house price, you'll see that whilst that has dipped back from the peak, it's actually really still pretty elevated. And of course, this is what causes first-time buyers in particular such a challenge, but will have a bearing on what kind of deal may be available to you when you're coming to remortgage. I think Rahul come on to that, so I won't spend too much time more on that. If we move on to the next slide, Joe, perhaps take a look at what interest rates are doing and have been doing. And this goes right the way back to when base rate was at its super low levels, right the way back to its first increase in December 2021. So you can see base rate is depicted in that purple line at the bottom. Above that, you've got the average of the lowest rates from the top 10 lenders. So that's on 2 and 5 year rates, just to give you a feel for how fixed rate mortgages have been moving over that period of time. And then soaring above that is standard variable rate, the average of the top 10 lenders. And you'll see just how much higher it is and why it's so important to keep your deal under review. Because even in the kind of volatile and difficult times that we've faced, standard variable rates still look way higher than the kind of rates you could be getting on a 2 and 5 year deal. So as you can see, base rate did start to rise really quite rapidly. So inflationary pressure forced the Bank of England to move quickly. That caused something of a panic amongst borrowers who were rushing to fix their rates. But that spike that you can see there is where the mini budget hit. And you can see how that sent fixed rates rocketing. Equally, it calmed down quite quickly, but rates hit around about 6% there, only to then spike again the following summer. So it's been a real roller coaster over that period, and that has clearly had a big factor in what borrowers are looking to do. How do they play it? How do they make sense of what's going on? In the midst of that, base rate peaked, and now as we move closer to where we are now, you can see how base rates started to come back down, and we're in a much calmer phase of the market. Thanks, Joe. Yeah, move on that one. So whilst we can see all that volatility, this again gives you a longer term view of what the kind of product choices have been for borrowers. So really those break down into two different types. When you're thinking about what should I do next, fixed or variable is typically going to be that breakdown. So if it's scaring you about what may or may not happen with interest rates in the future, will they go up? Could they come down? Fixed rates still taking up the vast majority of borrowers' decision making. So if you go to the left-hand side there, you'll see again, before the mini budget struck, which is that big spike in variable rate deals in the red, fixed rates were dominating, but 5 year in particular was really popular. Now that was because rates were so low that you could be picking up 2 and 5 year rates at the very lowest around or just over 1%. So therefore borrowers were much happier to lock into a medium term rate and take that longer term view because there was little downside and plenty of protection. Some borrowers will only just be coming off those super low rates of between 1 and 2%. So again, another reason that remortgaging is so important to approach and keep your deal under review. So that question of how fixing for how long, you can see on that pattern just how that has changed depending on the rate cycle. Now, as the mini budget hit, lots of borrowers decided that they would just take a holding position and decided to go for variable. And that's why we saw a huge increase in the popularity of tracker rates, because they're much less likely to tie you in. So borrowers were electing to take that as often as just a holding position to see what would happen with fixed rates. But what you can also see is that 2 year rates began to grow in popularity. So they began to take the lion's share, overtaking 5 year fixed rates, which previously had been the product of choice. And that's because borrowers are hoping that the blip in interest rates will be a blip, and that actually rates may come down. Now, there's no guarantees on that. And what you can see as we get closer to what's happening right now, you'll see how there's much more balance between how that's split up. So borrowers are thinking, actually, rates seem to have calmed down. 2-year could suit me, but I'm also quite happy to look at 5-year. And now you've got options that could allow you to lock in your rate for as long as you like, even for the life of the mortgage, certainly for 10 years, 15 years. So if you just move on, you'll see, again, we've got another way of just picking up how borrower choice and decisions have changed. You again see how the 5-year was so popular, but that's now much more balanced. And then just that spike in variable rates we've pinpointed there around the mini budget period. Now we may see more borrowers elect to go for variable, and there are benefits to variable rates. Tracker deals are directly pegged to base rate. So if base rate does continue to drop, then those rates will get cheaper. But of course, you've got to think about what might happen. We've still got a very uncertain world out there. So if things did change, how well would you be able to cope if rates didn't quite work out as you hoped? Bottom line, choose the right deal that suits your circumstances. Now, if we look a bit more on the next slide at where we've got to now, this is just looking at rates this year, and actually instead of these being fixed rates, the wiggly lines underneath are representing what are known as swap rates. Now, why are those important? Well, markets are trying to predict where base rate's going to head, and that's crucial for lenders because it determines how much they have to pay and the cost of funds for their fixed rate mortgages. So whilst base rate, the blue line above, we can see that stepping down periodically, and the expectation is that we'll still see further drops in base rate. Fixed rates have been going up and down, still looking quite volatile. I would say nothing like kind of 6% peaks, of course, that we saw in the mini budget period, but it is still impacting where mortgage rates are placed. So there's still quite a bit of repricing going on. Some lenders at the moment are still putting rates up. There's some coming back down. It's still pretty hard to second guess where rates are going. But the general broader outline is that the hope will be base rate will continue to fall as the Bank of England feels more confident that it has inflation under control and more sustainably under control. So it gives you a flavour of the things that you need to think about. And bottom line, I think you've got to focus on what's going to suit you best. If things don't pan out as expected and rates start to rise again, and you've gone for a variable rate, how well will you be able to cope with that? It could be worth it because base rate could keep coming down, but how well are you able to cope? If that scares you and you're not going to sleep well at night, then probably the security of the fix will still win over. But hopefully that just gives you a very whistle-stop tour of where rates have been, what's impacting those, and where we hope they might be headed in the future.
Brilliant. Thanks, Dave. No, that's super interesting. It's some great insights there. I guess, given your knowledge on the market, would you say it is best to hold off or lock in a rate, given that rates could be and are potentially on the decline?
So I think that's been a real big dilemma for borrowers in recent months. So as fixed rates have been moving up and down, there has been a tendency when they're on the downward trajectory that borrowers are saying, well, I'm in no rush because actually rates just seem to be getting lower. Perhaps I should hold off and wait till nearer the end of my current deal. I think we've also seen them then nudge straight back up again. So there is a risk that comes with taking that approach. And therefore, I think overall, you'd serve better by securing a rate, and you can do that in advance, take a deal, but then keep it under review. So if rates do keep on falling, you're actually able to then revisit the deal, speak to your advisor and see how they can help you take advantage of any further reductions if there are. If they go back up, of course, you've got a deal in the bag, so you're protected from those.
Brilliant, thank you. Some great insights there, which I hope has helped some of our attendees to understand, what's going on in the current market and hopefully when to act. So I think that is back to you now, Joe. Thanks for that, Dave.
Excellent, thank you very much. So now we're going to take a look at what the remortgage process looks like with L&C. So we're going to hand over to Rahul, who's going to talk us through it.
Thank you, Joe. Thank you. So remortgaging is essentially where your existing deal with your existing lender comes to an end and you switch to a new rate, albeit that could be with the same lender or a new lender. So for instance, if you move to a new lender, then the new lender pays off your existing lender. The charge on the property is moved from the existing lender to the new lender. This is the legal work involved. And your payments on the new deal will be made to the new lender going forwards. The main reason for remortgaging is to avoid dropping onto the lender's standard variable rate, which tends to be a higher rate. You'd have seen from the slides from Dave previously that the SVR indeed tends to be the highest rate out there. Then there are other reasons for remortgaging. For instance, a better deal because your loan to value has improved. For example, your property has increased in value. Or a different type of deal because your future plans have changed. For example, you're thinking of moving home in 2 years' time, so you want a 2-year fix instead of a 5-year fix. Or perhaps the market has changed, and based on your perception of the market, which again Dave was alluding to previously, you feel a tracker deal is more suitable to you compared to a fixed deal. Also, you might want to release some equity to do some work to the property, for instance, or to buy another property, or buy someone out, or pay off a debt. So all of these reasons are reasons which you could add on to the process of remortgaging and why you need to remortgage. Then typically, when the question arises, when do I remortgage? So typically you will start shopping around about 6 months before your existing deal comes to an end. And this window allows you to look at both new lenders and your existing lender. If you are switching to a new lender, offers from most lenders nowadays will be valid for at least 6 months. A broker will be able to help with this process and look at both the open market deals for you and deals that your existing lender is offering. We here at L&C, for instance, we don't charge a fee and will be absolutely delighted to go through your options completely free of charge.
That's fantastic. Thank you. And just to reiterate, if you're not quite ready yet to remortgage, you can scan the QR code on the screen and sign up to L&C's Mortgage Minder service. This will provide you with timely reminders about your deal end date, insights on the mortgage market, and fee-free advice at the perfect time. So now we're going to look at how a customer we supported at L&C who saved money on their mortgage with the rate check service that we provide.
Thanks, Joe. So again, going back to the volatility that exists in the market, although there may be a longer downward trend, but rates are still dipping in and out with lenders for various reasons to do with the swap rates, the market, the lenders at the forefront needing to adjust for their service levels, etc. So there's always that doubt in one's mind as to when within that 6-month window is the best time to lock in a new deal. So with L&C's rate check service, it gives you the absolute peace of mind that you can lock in a deal 6 months in advance, and we will check the market again for you close to your deal coming to an end and switch you to a cheaper deal if the rates have improved in the meantime. So in this example here in front of you, Anne locked in a deal 6 months in advance, and closer to the time of the deal coming to an end, we switched her to a cheaper rate available, saving her £3,720 over the 5-year period of the deal. So to put that in context, that equates to, for instance, a good family holiday. So it's nothing to be sniffed at. It's a substantial saving there.
Thanks, Rahul. And again, just to highlight, our rate check service has saved customers around 40 million last year, and already over 40 million so far this year, which is another great reason to consider L&C for your next remortgage. Now we're going to kind of take a look at the things to consider when you're remortgaging, as we know it could have been a long time for you, maybe 5, maybe 10 years, who knows? And we know things change frequently in the market, in the mortgage market. So I'm going to hand back to Rahul, who's going to talk us through some of the key things not to be missed. So back to you, Rahul.
Thank you again, Siobhan. So some key points now to bear in mind. The first one is if your property value has increased, which again, the first graph did show you that upward trajectory. So in most instances, it would have. And that puts you in a more favorable loan to value bracket, then you should be able to take advantage of a better rate based on the improved loan to value loan, particularly if you are the higher loan to values currently. So that's the first key point to bear in mind. The second point, another point to bear in mind is if you do move to a new lender when you are remortgaging, then the new lender will credit score you. So it is vital that you've kept up to date with your payments on all your credit agreements. Again, if there are any blemishes, not to worry. Again, a broker can help source the right lender for you. And again, highlighting the importance of speaking to a broker when you are remortgaging. Another point really, it may also be that a trigger has caused you to look to remortgage before that 6-month window. Now that could be, say, for instance, a significant drop in rates in the market, or you want to buy someone out. Again, get in touch with L&C and we can do the sums to see if it is worth moving to a new deal and pay your early redemption penalty. In some instances, it will be worth it. Okay. Finally, your existing lender will reach out to you 3 to 6 months ahead of your deal coming to an end. And although there's absolutely no harm in speaking to them to see what rates they offer, do not rush. Please do not rush to lock in a rate with your existing lender without speaking to a broker, as only a broker will be able to compare the deals across the market, including deals from your existing lender. Again, to reiterate, we here at L&C can help completely fee-free, no charge at all.
Thanks, Rahul. Some great things to consider when you're approaching the end of your current deal, which I hope you've all found super useful. So now I'm going to pass back to Joe for final takeaways.
Thank you very much, Siobhan and Rahul. So we know there's been a lot to digest today, and we've rattled through that fairly quickly as well. Great news is I can already see some fantastic questions popping up in the Q&A box, so we will get to those in just a moment and answer those for you. But I hope you've all sort of taken away some really, really helpful and useful tips, and hopefully you're feeling a little bit more confident about remortgaging. So if we jump onto the key takeaways from today's session, Dave and Rahul, back over to you.
Yeah, thanks, Joe. So without just going back over things that Rahul said, I think there's obviously so much to take in with remortgage. But early planning is one of those that's never going to be a bad idea. It gives you more time to put the deal in place. Remortgaging can take some time because you do have to make the mortgage application, receive the offer. That might only take a couple of weeks, but then there is also some legal work to work through. So you want to give yourself plenty of time. It's very basic legal work, but if you've got time to just do that in a nice, calm way, you'll have the deal ready to roll and have a nice, smooth switch over. So avoid the risk of dropping onto those high standard variable rates, which can be so much higher than the kind of deals that you'll be able to secure from the open market. And as Rahul says, a broker will always be able to look at the options from your existing lender as well. So you get the best of both worlds, comparing the open market with what your lender's offering you, and then the advisor can help you through whichever is the right route for you. Know your current mortgage details. Sounds obvious, but really useful. If you've got the mortgage offer or the details from your lender, perhaps from an annual statement, that will give you a really good idea of when that deal's coming to an end. So that's when you can make real use of things like Mortgage Minder, or to make a diary note of when your deal is coming to an end, because it may well be, 9 months, another year to go. That doesn't stop you thinking about what the right options are for you now, but it does help you just get yourself organized so you're ready to go. Things like loan size will also be critical. So that will come into play in terms of the choosing what the right deal might be. Those with a smaller mortgage will want to avoid some of the deals which might have lower rates, but also carry big fees. So some of the lender arrangement fees can be quite substantial, typically around £1,000, but can go beyond that. So if you haven't got a large loan, even though it's a lower rate, you could end up paying more over the scheme term. So again, an advisor will be able to do all of that for you, factor in what will be the best value for you. So that knowing your details, how long your mortgage has got left to run, all that, those kind of things will help get a good comparison together. Check your credit score we've got on there. Yeah, look, if you've got any worries about how your credit might have performed in recent years, have there been a few blips here and there? You can get access to your credit report. Credit reference agencies make that very easy to access these days. That might just reassure you that actually all looks well. If there is something on there that perhaps shouldn't be on there, then it can help you get to grips with that and have it removed. But also, if there have been some blemishes, as Rahul mentioned, that doesn't mean that there won't be options available to you. So that can be a really useful way of looking at your credit file. And then each lender will have credit scoring that they apply. Those aren't publicly available, but your advisor will have a good feel for what lender might suit what profile. And then shop around for the best deal. So, I would say that, of course, working for a whole market advisor, but shopping around will give you real surety that you're getting the best deal. In this market, there are literally thousands of deals out there. Each lender will have varying products with different fees, different rates, all at different LTV bands, loan to value bands. So it can, that choice is brilliant, but it can actually become almost a complexity that is hard to see through sometimes. So shopping around will I hope, would help you pinpoint the right deal and just open your eyes to what kind of features are out there and what kind of options could suit you. But how to contact us, I'll let you take over, Rahul.
Yeah, sure, Dave, sure. So although we focused on remortgages in this webinar, here at L&C we advise on all first charge mortgages and protection. So whether it is first-time buyers, home movers, you're buying a buy-to-let, or protection, so any kind of life cover, critical illness cover, income protection, etc., we can help. All you have to do is fill in our online inquiry form and post this webinar. Siobhan, correct me if I'm wrong, but everybody will receive an email with the QR code for this. So you can scan that code and you can fill in your online inquiry form, and we will be in touch here to help completely fee-free again.
Absolutely, yeah. Absolutely correct there, Rahul. So that brings us to an end. So now it's time for our hotly anticipated Q&A. Thank you for all your questions. I was just trying to read through some of them. So now we'll try and run through as many as we can. So let's get started. I'll have a look. I'll go from the top. I'll direct this one to you, Rahul. How do you work out an accurate property value for LTV? I've used two different sites who give me quite different values.
It's always a difficult one. You have to bear in mind that you're looking at two sides of the spectrum. You're looking from an estate agent's point of view. You're looking at, they're looking to get the highest value possible. From a lender's point of view, they're looking to protect their money. So they're looking at a conservative value. So ideally, one would look at the conservative value, but it really depends on how close you are to a loan to value bracket. So that's something, again, depending on your personal circumstances, it's a discussion to be had with your broker in terms of whether it's worth taking the slightly higher valuation and going down a more advantageous loan to value bracket and wait for what the lender valuation comes out at, or work on the conservative value and work upwards from there.
Brilliant. Thank you. I hope that's answered the question for you.
Fantastic. There was another one which I've accidentally moved aside, but I will jump back to that one. Really good question. Is there a different set of criteria for a remortgage application than a first-time mortgage, i.e. credit checking, affordability? Normally you're getting, or it says normally you're getting a lesser mortgage payment than you have been paying, ideally.
Is this for me, Joe?
Yes. Yeah, sorry.
Yeah. Well, credit scoring is something which is a bit of a mystery, really. So this is ultimately how the lender scores you in the background, and this is a plethora of points which are scored. It's not just your credit file, it is the fact that you've had a mortgage, they can see payments have been made, as opposed to a first-time buyer where they can't see that. So again, the loan to value has a bearing on it. So by the time you remortgage, you've probably built up a bit more equity in the property. So a lower loan to value attracts a more attractive credit score, for instance. So again, going back to answering the question, Joe, it'll depend on your personal circumstances. But for some of the factors which I've just mentioned, remortgaging your credit score should look better than as a first-time buyer.
Excellent. Thank you.
I think we've got one here. I'm going to direct this one at you, Dave. Are we reliable for ERC if we sell our home before the fixed term ends? If it's still worth to do fixed term if we plan to sell in the near future, so our early repayment charge?
Yeah, really good question. And a key thing to think about when you are thinking about how long to fix for. Often the temptation is to think, well, what's going to work out the cheapest? But actually thinking about how your lifestyle might change and how your needs and your plans might change. So maybe there's a move for a growing family on the cards or whatever it may be. Thinking about early repayment charges should be central to that product decision. So if you were to move and to pay off that mortgage and take one from a different lender, then yes, the early repayment charge would be payable. However, most lenders will allow you to take that deal with you to a new property. So it's often referred to as porting the mortgage to the new property. The only thing you've got to then think about is if you do need some top-up borrowing on top, so perhaps you're buying a bigger property, then that borrowing, you'll still need to be able to meet the lender's criteria for that larger borrowing. And what you don't know is in the future, will your lender still have some of the best rates available for any top-up borrowing, because that will be on a different deal that's available at that time. So thinking about when you've got a plan change coming might well help you determine how long you want to fix for. So if that's perhaps a couple of years away, you might go for one of those shorter term 2-year deals rather than locking in for 5 years or longer. But there are still alternatives if you need to move and take the deal with you.
Perfect. Thanks for that, Dave.
Fantastic. Thank you. Next question then. Is it plausible to extend the duration of your remortgage beyond the age of, say, 67? Rahul?
Sure. Yes, it is. So there are two things really. One is all lenders have a max lending age. So that could be 70, 75, in some instances higher. So the term of the mortgage needs to take you to or just below that max age that they are willing to go up to. And if you're looking to use your current income for that length of time, then what you do for a living needs to be plausible. So if you are saying you're going to work till the age of 75, what you need to do or what you do for a living needs to marry up to that. But yes, when you are remortgaging, you can of course extend the term of the mortgage if you want to. From an advice point of view, we don't normally typically would advise to increase the term, only because you end up paying more interest over the term of the mortgage if you extend the term. But then again, based on your circumstances, you may want to or need to do that. And again, each time you remortgage, you can always adjust the term. It's not, once you fix it, it's not fixed for the term of the mortgage as such.
Yeah, the fact you're essentially applying for it with a new lender for a new mortgage means that it will be subject to their criteria. And typically, I think it's fair to say that lenders have become more flexible for older borrowers. But one of the bedrock requirements will be that the lender can see that that mortgage is going to be affordable for you. And so there will be questions around whether that takes you post-retirement, etc., etc.
Fantastic, thank you.
Brilliant. I got on here. I'm gonna ask you this one, Rahul, if okay.
Yep.
Can L&C help with let to buy?
Yes, of course. So let to buy essentially is where you're living in a property and you're thinking of moving. So what you want to do is rent out the property you're living in and move to your next home. So essentially, sometimes you're looking at two mortgages in that scenario. You need a mortgage to cover the property you're living in, and that could be a buy-to-let mortgage. Or sometimes you can leave the mortgage as it is and get a consent to let from your existing lender. And then you look to get a new mortgage for the new purchase going ahead. So as far as advice is concerned, it's a bit more complicated in the sense that some lenders use different stress tests for the property in the background. But of course, we can help with that. It's nothing different than having two mortgages or looking at two scenarios. One is a remortgage for the property you're going to rent out, and one is a purchase for the property you're going to looking to buy.
Brilliant. Thank you.
Excellent. The questions keep coming. This is amazing.
I know.
We've got a couple that I'm going to kind of bundle here together because they're both about rate checks. So if I lock into a deal with L&C, will I be able to decline it in the event that my current mortgage provider offers a better rate? And then also, if I've already enlisted solicitors for the remortgaging process, won't they charge me for work they've done if I eventually switch later on? Dave, for you, I think.
Yeah, good questions. So remind me of the first one, Joe.
If I lock into a deal with L&C, will I be able to decline in the event that my current mortgage provider offers a better rate?
Yeah, so up until the point that you complete, typically you'll be able to change that deal. Now, whether that's with the lender that you've already got an offer with, or whether it's starting over and going to a different lender. So that could be that you secure a rate with someone else. The market moves, and now they're no longer looking as good as the leading rates, whether that's with a different lender or whether it's with your existing lender. Now, the rate check process will help you with that because they will help, the advisor will be able to look at what those options are, and also establish, whether there's a time issue for one. So the closer you get to the end of your current deal, that will determine some of the options open to you, because you probably will not want to start a new application with a different lender altogether, because it could just take a while to get through, and that could risk you slipping onto standard variable rate. But they will hold up the deals from the existing lender, and they will be able to access those for you as well. So you don't lose out on that. And if there's no other fees that have been paid to the lender, no upfront booking fees, etc., then you should be able to cancel that and restart, depending on which way you want to go. The second one around the legal work. Now, a lot of lenders, which is a really good point to mention here, whilst there is some legal work, as I mentioned, that basic legal work will often be covered as part of the lender's incentive package. So they'll often give you money towards that. So either by using the lender's nominated solicitor, or alternatively, they may offer a cashback. And I think I did see another question around, can we help point people in the right direction for that? We would be able to let you know what the options look like on that front. So actually you could use that cashback, use a solicitor of your own choosing, and that cashback would be geared to covering most or all of that legal work. So it is a fair question around incurring costs. Some deals will carry upfront booking fees. In that case, they're likely to be non-refundable, but they're few and far between these days. But again, that's something the advisor would weigh up as part of that process.
Excellent, thank you.
Perfect. And I think there's a couple here in terms of can LNC help? So maybe one for you, Raoul. So one around we're looking to remortgage due to doing renovations on our property. And we had another question around I think LNC helping with suggesting solicitors as well. So yeah.
Sure. So in terms of doing some work, so depends on the level of work you're looking to do. And if you're looking to raise some money to do work to the property, in most instances, that's absolutely fine with the lenders. So it is quite a common reason for remortgaging where you are capital raising to put towards the money towards improving the property. So the lenders don't have any issue with that. It sometimes depends on the level of work. So if you are looking to completely bring down all the exterior walls and rebuild from scratch, that may be an issue. But again, for typical improvements to the property, it should not be any issue with most lenders out there. What was the second one again, Siobhan?
It was can LNC recommend solicitors?
Sure. So we do work with a panel of solicitors, and they're all monitored quite closely with the service levels they have. So at any given point in time, depending on the service levels they have, we recommend the one with the best capacity to take on work. So with some remortgages, we've agreed on prices which are extremely competitive because of the volume that we normally give to these firms. And hence any package that we recommend for remortgages is extremely competitive.
Perfect. Thank you.
Excellent. Okay. Next one. Am I able to get 2 options locked in 6 months early? We're planning to extend our property, but we haven't decided if we should increase borrowing for works or keep mortgage payments low and save for the works. Who would like to take that one?
I can take that if you want. So yes, some lenders will allow you to have 2 open mortgage applications, but not all. Bearing in mind that each time you make a full mortgage application to a lender, you do get credit scored fully. So it's not a soft credit score, it's a hard credit score. So it leaves a footprint on your credit file. In a scenario like that, where you're sort of caught between a rock and a hard place in terms of wanting to borrow more for the work or saving up, again, based on your circumstances, the advice would be tailored to that. But one can argue you could probably look to borrow more. And then obviously, if you didn't need the money, depending on what that amount is, you do have the overpayment facility, which normally equates to about 10% of the mortgage balance, which you can pay back to the lender at any given point in time without any penalties. Does that answer the question? Okay.
It does, I think so. Thank you.
Perfect. One here for you, Dave. What about Help to Buy? Is it worth paying it off, or would it be cheaper to pay interest due to the current rates?
So it's a really difficult one to answer that, because Help to Buy worked as an equity loan, and therefore the amount that you have to repay will depend on what happens to property prices. So saying it's better to do that right now, we just don't know what may happen to house prices in future. And you may turn around and say, well, actually, if I'd waited, that prices would have dipped and I would have had to pay back less, because the 20% typically would be repayable as 20% of the current market value. Obviously, with the equity loan itself, it was interest-free for a period, but that also carries a cost now. So you can hold that up against the kind of current mortgage rates that you could get, but you do have to factor in that element of how much has the property changed in value, and should I get out sooner if I can, or hold off and carry on paying on the equity loan. So it's an impossible one to say this is definitely the right answer. But again, it's the kind of thing that you can look at remortgaging. Most of the time you'll need to remortgage and pay off the entire equity loan. So having a rough idea of what that might look like will help you gauge what the cost of a new mortgage might look like. And that will perhaps just open up your mind to whether that feels like the right thing to do right now. Anything Rahul missed there?
No, I think you're absolutely spot on, because ultimately, given where the rates are now, and again, going back to one of the graphs which Dave mentioned, where a lot of people will be coming out of fairly low rates, you may see a substantial spike in your payments. So ultimately, it'd be a question of weighing up, if you do pay off that loan with your new mortgage size and the increased rates, how comfortable you are with affordability on that, apart from obviously the right time in terms of whether house prices are the right time, etc. That in itself would be a hard line which you can very easily see whether it's the right thing to do or not.
Brilliant, thank you.
Excellent. There's a few more that I'm going to throw together because they're on a kind of a similar theme. So Raoul, one for you, I think, here. So kind of what are the rules, or so can you remortgage to use the money for debt consolidation? Could you remortgage to help children buy a property? Or could you remortgage to borrow to buy a new home?
Sure. So yes, the answer to that question again is yes to all three. Now, the reasons for capital raising vary lender to lender. Okay, so some reasons are quite common and most lenders are fine with. For instance, the one which we answered earlier, which is with regards to borrowing money to do improvements to the property. That's quite a common one. Debt consolidation, again, it's a very sort of specific reason for capital raising. So one needs to work that through very carefully, because bearing in mind, sometimes you're consolidating debts which are short-term into a long-term debt by taking it over the term of the mortgage, and hence overall you'd end up paying a lot more interest. So there may be circumstances where it is the right thing to do, but again, that is very circumstance specific and needs to be talked through with a professional who will guide you through the process of asking the right questions and making you think whether it is in fact the right thing to do or not. The other piece in terms of raising funds to help your children get on the ladder, again, not an issue with a lot of lenders out there, but based on, again, your affordability, how old you are, whether you need to extend the term, would the term extend beyond your retirement age, all of those questions will crop up. And in terms of the final reason, which is to buy another property, if it is a buy-to-let and you're capital raising to purchase a buy-to-let property, again, not an issue, but some lenders may want the address of that property before they release the funds. And there are a few in the market who may not even ask that question. If you are capital raising to purchase another residential property, again, affordability will be stretched across both properties. So again, one needs to have that conversation with the broker to see whether that fits affordability. And again, if you are looking to purchase one main residence and rent this out, again, it would probably be a different type of mortgage you may need to take on, which is a buy-to-let mortgage, and borrow the extra amount you need within that buy-to-let mortgage.
Excellent, thank you.
Perfect. So I think this is a question around bank statements. So what do banks look for in bank statements? My recent bank statement shows outgoings as higher than incomings due to a big birthday. I do have substantial savings, no overdraft, good credit. So does this mean bank statements do not matter as much? I don't know who wants to answer that one.
I can do it, or Dave, whichever. Do you want to take this, or do you want me to take this?
Well, my take, Raoul, and you correct me if I'm wrong, but
Sure.
no, the bank statements, affordability, which all lenders will do, is all about looking at committed expenditure and making sure that there's nothing in there that the borrowers are going to have that's an ongoing cost, which should be factored into their affordability calculation and perhaps hasn't been. So it can flag up things which quite clearly perhaps should have been disclosed at application stage. I think this sounds like it's probably more around occasional, it's using the money in the current account to fund a one-off expenditure. And therefore, I wouldn't see that as being something that would be overly concerning. And certainly, if a lender has got a question around it, they'll come to us and we'll be able to seek the answer. And hopefully that will be enough to allay any concerns about whether that was signs that there was additional expenditure that hadn't been factored in. What do you think, Rahul?
Yeah, absolutely. I think spot on. So what the lender's looking when they're looking at bank statements is if there is any committed regular expenditure which has been missed out, which needs to be factored in, whether you are living within your means on a regular basis. And finally, is there anything on that statement which they aren't comfortable with? So it could be, again, it's in very rare occasions, things like regular gambling expenses, things of that nature might raise some questions with some lenders. So it's, again, very specific with lenders and circumstances. But like Dave mentioned, in most cases where it's a one-off thing, etc., and there's a plausible answer, we can always argue that with the lender on your behalf.
Brilliant. No, thank you for that. I know we've got just under 5 minutes to go, so maybe a couple more then, Joe.
We'll go for a couple more.
Yeah.
Dave, one for you. Can you take a straight interest-only mortgage when you remortgage?
Usual will be yes, depending on the situation. So yes, you can. Lenders do still offer interest-only mortgages. Those sort of came under the spotlight after the financial crisis, but lenders do offer interest-only. And so therefore, if you were remortgaging, you could look to apply for that on an interest-only basis. Now, what I would say is that the criteria around interest-only is a lot more prescriptive than it was, prior to the financial crisis, going all the way back to the credit crunch. So it would be worth a conversation with an advisor around what kind of eligibility requirements might be. So that some lenders will have minimum income requirements, and certainly what they will want to know is about what the repayment strategy is. Now, that could be that you plan to sell the property and use the proceeds to sell it off when you downsize. But again, that can come with criteria requirements, typically requiring a sometimes very substantial equity buffer in the property. So I want enough equity in the property to be able to cover that criteria requirement. So it is possible, yes. It's just working through those additional eligibility requirements and showing that there is a strategy in place for repayment.
Brilliant. I'm going to pop these two together. So probably one for you, Rahul. If I'm a newly self-employed, how this affects my remortgaging? And then we've got a separate question around bank statements. How many months worth of bank statements are required for a mortgage?
Okay. So back to front, in terms of the bank statements, typically 3 months, but it could be even a month with some lenders, but typically 3 months. If you've recently gone self-employed, typically with self-employed, what the lenders will use is any salary you've taken, any dividends you've taken, and they want to see a track record. So typically 2 years, that's the typical scenario. But there are lenders there. Affordability has been a big discussion in the industry for a while. So there are lenders who are making it a little bit more flexible in terms of what they look at. So there are lenders, for instance, who will lend based on a year's worth of tax returns and a projection for the new year. It also depends on what that is, in the sense that, have you been trading as a sole trader, for instance, and have converted that into a limited company more recently. You haven't really changed the business, the structure has changed. So again, that's looked at a lot more leniently than, for instance, setting up a company from scratch more recently. Again, things may be different. For instance, if you're a partner in a law firm, you've been employed by them and you've been made partner very recently. Again, there are lenders who would accept a letter from the practice, from the finance manager in the practice, to confirm what the earnings would be going forward. So again, the answer is yes, but it comes with the caveats I've just mentioned.
Perfect. Thank you. And I think, Joe,
We are very quickly running out of time. So thank you so much for all your questions. We've had an amazing number. And thank you, everybody, for attending. Hopefully, we've given you some really useful information today. Thanks to the panel, Dave and Rahul. You've been really excellent, given some great answers to the questions that have been asked. And thank you to my fantastic co-host, Siobhan. When the webinar does finish, you should be redirected to a really quick little survey just to gain a little bit of feedback. This is the first one of these that we've done, hopefully not the last, and your feedback will really help us kind of guide stuff moving forwards. Hopefully we'll see you again for any future webinars that we hold. In the meantime, have a great evening, go and enjoy some sunshine, and we'll see you again soon.
Thank you.
Cheers, Joe. Thank you.